The average true range is a volatility indicator originally developed by J. Welles Wilder, Jr. for commodities. The indicator does not provide an indication of price trend, simply the degree of price volatility. The indicator moves up and down as price moves in an asset become larger or smaller. In this chart, you can see that the ATR remains relatively low and flat during a range market. Once the market tends to start moving in one direction, in this case in the bullish direction, you see the ATR start to go up. Then the next level smooths out to a ranging period again, and then we have another breakout to the bullish side, and the ATR also goes up as well. Keltner channels are indicators that are comprised of three lines and measures volatility, with the middle being an EMA and the two outside bands being ATR. Price reaching the upper band is considered bullish, while reaching the lower band is bearish. Keltner channels are a trend-following indicator used to identify reversals with channel breakouts and channel direction. The Keltner channels may seem a bit similar to Bollinger Bands, and also to Donchian channels. Notice in this slide that when the candles break through the upper band, we see that it is obviously overbought, and the ensuing direction turns reversals and hits a bearish trend. The stochastic oscillator is a very commonly used indicator for traders on the market. Whenever the stochastic dips below the 20 mark, it is an indication that the market for that indicator is oversold and a trader can expect a price reversal or correction. The opposite is to be said whenever the indicator goes above 80, as then the market is overbought. Notice on this chart that numbers 1 and 2 show an overbought condition with a price correction after. During this bullish run, these could be indications to get out of the trend as it may be reversing. With a proper stop loss and take profit or trailing stop, you won't have a problem getting out of a trend with a decent profit. Notice on number 3, it shows an oversold condition and after a continuing in the long-term bullish trend. The Commodity Channel Index, or CCI, is very similar to the Stochastic Oscillator, in which it shows oversold and overbought conditions. It is also used to draw trend lines and to discover divergence. Notice on this slide that when the candlesticks are in a bearish state, the CCI tends to stay below the negative 100 line, all throughout that bearish trend. Once we see the CCI cross over the 0 line and head to the 100, this will be a good indication for most traders to exit the trade. Developed by an American trader, Alexander Elder, the Bull's Power indicator aims at identifying if a bullish trend will continue or if the price has reached a point where it may reverse. As the name suggests, Bull's Power is used to estimate the power of the bulls, or the buyers. Notice on this slide that with the Bull's Power during this bullish run, the indicator stays well above the 0 line. There are a few spotty times at the beginning where the Bull's Power goes below the 0 line and we see a small correction. Thereafter, we see a continuing Bull's Power run all the way to the end of the slide where we see a little more constant bearish movement. The bear's power is exactly the opposite of the bull's power indicator. As you can see on the chart here, we are in a bearish downturn and the bear's power volume presses below the 0 quite heavily until towards the end we see a reversal in the price action and we can see that the bear's power recedes back towards the zero line, and eventually goes above the zero, confirming the price change. The moving average convergence divergence, better known as the MACD, is an indicator made up of two moving averages with different time periods. When the two lines cross, this is an indication of a potential trend change. When the blue and red lines cross over the threshold, this indicates an official trend in that direction, as seen with the first green arrow. The MACD was created by Gerald Appel as a technical indicator for stock prices in the late 1970s. It's designed to reveal changes in strength, direction, momentum, and duration according to a trend in a stock's price. It's also very useful to use it with support and resistance lines. Relative Strength Index, better known as RSI, is a commonly used indicator to depict overbought or oversold market conditions, and it's very useful to use during a trending market. In this image, you can see a bear market, and at each oversold signal, which means the line goes below 30, there is a slight uptick as a correction. Then the bearish trend continues. This can help traders with entry and exit points in a trending market. You always want to sell at the top and buy at the bottom. Alright guys, that concludes our oscillators section. Hopefully you understand oscillators a bit better and how they work. Very simply put, they measure whether an instrument is overbought or oversold. And it allows traders to find their way into an already good trend or to exit a trend based on their technical analysis. Hope you guys enjoyed. Stay tuned for the next.